back for more. I like it. Class 2 is here. You did it. You found it. Great job. If you're here on our website, thank you so much. If you're here on our YouTube channel, make sure to subscribe if you haven't done so already. You are an amazing person. Let's get into Class 2 for this Futures program. I know you like Class 1 and there's so much more content ahead. I am pumped up and jazzed about this. Let's make magic.
It's showtime, folks. Hello, real life traders. How's everybody doing tonight? Wow, welcome back to Real Life Tradings. This is Futures class number 2, similarities and differences between futures and equities options. My name is Caryn. I'm here to help each of you reach your next level in your trading, not just in futures, but in all the markets you trade. We're still really close to the beginning of our journey. So if you're already trading futures, this class might be a little basic for you, but you never know. There might be a tidbit here or there. If you check out early, no hard feelings, but please come back. Things will get more interesting for you as we move forward. Now, everybody, put away your credit cards. You don't need them. There's no sales pitch. We will make no effort to separate you from the contents of your wallet. Our goal is to help you learn and succeed, not rob you blind. This series of classes is absolutely free all the way to the end, just a few short weeks from now. So turn off your cell phones and the TV, log out of all your social media, because it's time to focus on futures. But first, this message from our legal department. Trading is risky. Never risk money you can't afford to never see again. No one clicks your mouse but you. Click responsibly with full knowledge, personal accountability. Each decision to click that mouse is yours and yours alone. Okay, let's do a quick review, sharpen our minds up. What is the purpose of the market? Type it in, go ahead. What is the purpose of the market? Yes, oh my God, you guys are awesome. Purpose of any market. Facilitate trade. That's the purpose of the stock market, the futures market, eBay, Craigslist, the local farmers market, you name it. The purpose of any market is to create a common venue where buyers seeking particular goods are able to trade with the sellers of those goods. A successful market makes the process of buying and selling easy. Now, easy doesn't mean easy to make money. It means easy to do business. You got to admit, if you're trading a stock with enough volume, it's very easy to buy or sell, right? All you have to do is click your mouse. It may not be a profitable trade, but the act of completing a trade is pretty easy. Any market, whether it's goods or services, somebody wants to sell, somebody's looking to buy, and a market brings the two together. Does anyone remember what the facilitators of the futures market are called? I'll give you a hint. They also guarantee you get your money or the goods you paid for. Literal, on the money, exchanges, absolutely. Yes, the exchanges. Futures contracts only traded through and guaranteed by an exchange. Whoa, that wasn't supposed to happen. We go back now. The exchange standardizes the contract terms to facilitate trade. Highly leveraged, both the buyer and seller are obligated, and they are derivatives. Okay, let's move on. And make sure we've got the pen this time. Okay, and we took a close look at this portion here. Let me get there. This portion here of the NASDAQ definition of a futures contract. Let's test our memories. In an options contract, who is obligated by the contract? The buyer, the seller, or both? In an options contract, only the seller is obligated. If the seller of an options contract that is in the money wants to avoid exercise, how does the seller offset the position? Very good. Okay. Is there any other way for the seller of an option contract to avoid getting exercised? Yes, rollover. Very good. That's one answer. That's about it, isn't it? The only other way is to get rid of it. Okay, so there's no other way to avoid exercise. So the seller needs to offset the position, either through rollover, buying another option, or just closing it. Okay. Now, this gets a little tricky. How about the option buyer? Does the option buyer have to do anything? Well, it kind of depends, doesn't it? I mean, if the option is out of the money and the buyer wants to, very good, Fred, exercise, they have the right to, but it's rare because if the option's out of the money, it's cheaper just to buy the stock than exercise, right? So what if the buyer's options contract is at the money? What do they do then? Yes, the seller is obliged. What's about the buyer? No problem if it's at the money? Yeah, okay, I'll go with that. But just to be sure, I recommend calling the broker. Tell them not to exercise if you don't want the stock. Okay. How does the buyer of an options contract that is in the money avoid getting exercised? Yes, exactly. Sell to close, call the broker, tell them not to exercise. And if the option buyer has an in the money contract and wants to get exercised, what does the buyer do? Excellent. Absolutely nothing. So for the option buyer, it doesn't matter if the option is at the money, in the money, out of the money. The buyer can do whatever they want. That's their right, even if it's financially unsound. The buyer of an option has all the choices at expiration. Sell to close, exercise, don't exercise, let it expire worthless. Now, the seller of an option has only one choice to make if the option is at the money or in the money, and that's offset the position. Buy to close, roll it out, or get exercised. Now, with a futures contract, who is obligated? The buyer, the seller, or both? Oh, you guys are good. This is going to be awesome. Okay, yeah. A futures contract obligates both the buyer and the seller. Now, if both the buyer and the seller are obligated, can the contract expire worthless? No, it can't. Does it matter if the contract is in the money or out of the money, at the money? Nope. Doesn't matter. With the exchange, a deal is a deal. The buyer's got to pay, the seller's got to deliver at whatever price the contract traded at. It doesn't even matter what the price is now. A deal is a deal, and the exchange will hold everyone to the agreement. What is the only way to avoid assignment if you've bought or sold a futures contract? Fred Atwater, you are one smart cookie. Exactly. Close. Well done. We are cleared for takeoff. Derivative contract. Futures contracts are derivatives. Both options and futures are derivatives, which is just a fancy way to say the value of the contract is derived, get it? Derivative, derived from something else. And most derivatives involve the eventual delivery of whatever the thing the price is based on. So all you option traders, what are options a derivative of? Yes, stock. Very good. Okay, so if you're trading IBM puts, the underlying instrument is? Excellent. Apple calls? Excellent. Okay. Oops. Okay, so the underlying instrument for an equity option is the stock. Options contracts are derivative products because the value of the option depends on the value of the underlying stock. When an option is exercised or expires in the money, the result is a stock position that's delivered electronically. So an option getting exercised, it's not really a bad thing, right? I mean, sometimes it's exactly what you want to happen. Might have been your trading plan all along. So options traders, I'm going to put you on the spot one last time. What costs are associated with an option getting exercised? Okay, fees, transaction fees. Very good. Yeah, the price of the stock. Yes, exactly. Okay. So the only other cost I can think of is if the option is in a margin account, there might be interest on a margin loan. So futures contracts, like options contracts, are derivative products, which means there's an underlying instrument involved. Equity options based on stock. What do you think futures contracts are based on? Oh, Jason Smith on beans. You guys are funny. Yes, the commodity. The underlying instrument for a futures contract is a commodity. Great. So when an option contract gets exercised, what gets delivered? The underlying stock. What do you think gets delivered when a futures contract gets assigned? Exactly. Exactly. The underlying commodity, which sadly will look like this. And plenty of it. If you can touch it, then it is a physical commodity. And if the underlying instrument is a physical commodity, the futures contract will settle in stuff. There's only two physical commodities that settle in cash: butter and cheese. That's it. All the rest of the physicals settle in stuff. So, quick little test. Can you touch the S&P 500? No. Okay. So, does it settle in cash or in stuff? Very good. How about the VIX? Can you touch the VIX? Cash or stuff? Good. The indexes and the VIX are not physical commodities. They settle in cash. Can you touch a cow? Oil? Soybeans? Cash or stuff? Excellent. Okay, now I'm going to put you to the test. Treasury bills, Japanese yen, euros, cash or stuff? I got you guys. This is stuff. You can hold a euro in your hand. You can hold a Japanese yen in your hand. And believe it or not, a treasury bill is a piece of paper. It is stuff. Okay, very good. Those are all physical commodities. And futures contracts that have a physical commodity as the underlying instrument, except which two commodities? Yeah, but for some reason, Matt, butter and cheese are settled in cash, which is why I say, except which two commodities? Okay, excellent. So they settle in the commodity the contracts derive from, stuff. And yet stuff needs to be paid for. And the broker is not going to finance delivery of a futures contract. If the account doesn't have the liquidity to buy 20 tons of live cattle, you'll probably need to get a bank loan to pay for the stuff. And they will have to be transported, stored, insured, maintained in usable condition, which might include air conditioning or being fed and cleaned up after. Those are called carrying costs, and they can add up really quickly. So what do you think? Does getting assigned stuff sound stressful? Maybe just a little bit? Yeah, futures assignment will take up a lot of your time and attention. It's pretty dang awful. Me personally, I would much rather be trading and making money than dealing with an assignment, wouldn't you? We'll get to that, Fred, about futures and assignment. Thankfully, the brokerage would prefer we spend our time trading too. I wonder why. They try to help us stay out of trouble. They'll flash reminders about first notice day and last trading days on your trading platform, but ultimately, the responsibility is our own. A futures contract getting assigned is a big, ugly deal. Retail traders like us never want a futures contract to get assigned if it settles in physical stuff. So, how do we avoid assignment? Come on, you guys, know this? Okay, yeah, buy to close or yes, offset prior to expiration. Trade the sucker away. All righty, excellent answers, you guys. Let's move on. Okay, do these commodities settle in cash or stuff? Excellent. Okay, you guys are all over a bit. How about these? Cash or stuff? Except? All right, good, you guys. Butter and cheese, all except butter and cheese. What about these? Do they settle in cash or stuff? Well, this is kind of a mixed bag. You have to know your instrument because some of these are cash and some of them are stuff, which brings us to the 4 cardinal rules. Here we go. These 4 things in red are crucial to staying out of trouble in the futures market. That's why they're in red. Trading futures is a lot like trading stocks and options. It's all about support and resistance. The charts look the same. The patterns have the same meanings, but there are some basic differences and some new terms. We'll go over all of them as the classes move forward. But these 4 rules are first and foremost and must dominate every trade. If you ignore these 4 things, it doesn't matter how great a trader you are, you will go bust. It's just a matter of time. Number 1, know your instrument. If you think blowing out an account is bad, then you don't know futures. Assignment on a physically settled commodity is a gazillion times more painful than blowing out a $20,000 or $30,000 account. When an account gets blown, you can't lose much more than the amount of money that was there. If you get assigned a physical commodity, you might lose your home, your life savings, the works. The worst stuff comes from not knowing and understanding the instrument you are trading. First notice day, last trading day, expiration, settlement date, trading hours, tick size and value, intraday and overnight maintenance. These are all things you'll need to know. And as we go through the classes, you'll learn what each of these contract specifications means and how to look them up. Before you even plan a trade, you must know these details about the instrument. Well, you may ask, how do I get to know my instrument? Well, it couldn't be easier. Ta-da! Just type in the name of the futures product you're interested in and the words contract specifications. Boom, you'll get everything you ever wanted to know and more, believe me, about the instrument you're interested in. Each exchange presents the information a little bit differently, but it's all there. You can also get it from your broker and other charting sites. Here's barchart.coms. You don't have to memorize this stuff. In fact, there's no point in memorizing it because the exchange can and does from time to time change the specifications of a futures contract. It's better to check and be sure than to assume and be wrong. Now, where were we? Oh, yeah. Oh, yeah. So both options and futures contracts, highly leveraged derivatives. Some are settled physically, some are settled in cash. Different commodities settle in different ways. Know your instrument, guys. I can't say it enough. You're going to see that slide a lot. Futures contracts never expires, worthless, because the buyer's obligated. This is repetitive. Okay, now one more thing to notice that's very, very important. When we were talking about options, I used the term expiration. We have to close the position before expiration to avoid getting exercised. But when I talk about the futures contracts, I'm using a different word. I'm using the word assignment or assigned, because expiration on a futures contract does not have the same meaning or implications as an options expiration. Now, I'm talking about US style options here that are rarely exercised before expiration unless they're deep in the money. And, sometimes that's what we're hoping for. But futures have different terms for expiration and not just different from options. Expiration for a futures contract is different for different instruments. That's part of why it's so important to know your instrument. Physical commodities, you remember? Stuff, with the exception of what? Yes, exactly. With the exception of butter and cheese, which are cash settled. Start getting assigned on something called first notice day. You might hear people refer to it as FND. First notice day is before expiration. Sometimes it's as much as 2 weeks before expiration. First notice day is when the exchange begins assigning buyers to sellers. And like we said, assignment is much worse than getting exercised on an equity option. Futures traders never want assignment. Once assigned, there is no turning back. The buyer is required to pay in full, seller is required to deliver, and we pretty much covered what a joyful experience that would be, right? What's cardinal rule number 1? Oh, very good. Know your instrument. Okay, quick pop quiz. How does an obligated seller of an option avoid exercise? Seller of an option, how do they get out of getting exercised? Option seller. Very good. Close, buy to close, exactly. So, futures contract, who is obligated? Excellent, both the buyer and the seller. So, what does the futures contract seller need to do to offset the position before assignment? Futures buy to close, exactly. And the futures contract buyer, the long position, what do you think a long futures position needs to do before assignment? Exactly. You guys are awesome. What a group. Okay. So it may sound like the seller in a futures contract has an easier time at assignment, but the seller's got to provide the commodity. Anybody here have 100 ounces of gold ready to deliver? Or 40,000 pounds of lean hogs? Yeah, me either. All right, well, do you have enough cash to get 100 ounces of gold or 40,000 pounds of pigs? Right, it's the same situation, right? You're going to need a loan and fast. All right, well, say you do have the cash. I don't know why you're here with me, but say you've got the cash. I mean, do you know where to get it? You can't just buy this stuff on Amazon. And can you deliver it for less than the price the futures contract obliges you to sell at so you don't lose money? So does it sound fun to be the seller of a futures contract at assignment? No, of course not. We are retail traders, not commodities dealers. Retail traders, oh boy, my tongue tonight. Retail traders always want to be flat, physical commodities, before the first notice day, FND. Flat means all positions are offset, whatever it takes, buying or selling, depending on the open position. Ever seen this before? News events. Instead of quarterly earnings, the futures market has economic reports and central bank meetings. Nearly every week of the year has a potentially market-moving event on the schedule. You don't have to understand the data. You don't have to know what it means, but you sure need to know when it's scheduled for release. Nothing worse than getting blindsided by scheduled news when you're in an open position, or surprised when the data affects an instrument that's correlated. You'll have to come back for the second round for the class on correlation, and we'll also cover data and news as catalysts in round 2 when we get into trading the individual instruments. But for now, just be aware that correlations in the futures market create a lot of opportunity around data releases. Some instruments tend to move together, some tend to move in opposition, and when they don't conform to those normal parameters of correlation, that's meaningful too. Now, position size is crucial in the futures market. We are here. Control, position size. It's huge. The leverage is 10 to 1 at the smallest, and it's usually a heck of a lot more. If you're on the right side of the trade, it is awesome. The cash adds up really fast. It is so much fun, and you wish you had more contracts, but it's really good that you don't. Because if you're on the wrong side, let me tell you, those losses add up even faster, and it is so much way less fun. And if your position size is too large, it will ruin your week, your month, possibly your life. We're going to get into all the details on figuring out position size, again, in round 2, when we get into trading individual instruments and have the ticks and point class under our belts. For now, remember, too many contracts, impatient entries, moving stops will blow up your count. It's just a matter of time. You might squeak out of a bad trade 9 times out of 10, or even 99 out of 100, but it only takes one unexpected news-driven market move to wipe out an entire month's work or even an entire account. Take, for example, North Korea shooting off a missile just the other night. Market sank 30 points in about 2 minutes. Came right back up, but if you don't have the margin, you're going to get blown out. I'll share the rules and the tools. Once you understand them, the most important and hardest part of futures trading pardon me, is yourself. And it's going to take more than one night. I want you guys to be patient with yourself. As you learn, as you grow as a trader, be patient with the market. Wait. Always wait for the right entry. If you've got the right entry, that means your stop is going to be in the right place. And you can honor your stop and not feel bad that you got stopped out of a trade that should have worked or did work as soon as you got stopped out. It's better to miss a trade than to try to squeak in at a bad price. Always, especially in futures. Now, I'll get down off the soapbox now. There was a reason I mentioned position size, even though we're not going to get into risk management and stop losses right now. And that reason is, well, it's complicated. Let's start with nightly settlement. Each evening after the session close, a futures account is cash balanced to reflect the day's settlement price on all open futures contracts. Real money is actually added or removed from the account based on the daily settlement price in relation to the open position. Now, that doesn't happen with options contracts, does it? I mean, price moves all over the place in options contracts, and it only affects the paper balance of an account. They don't actually take cash out of your account based on the options value at the end of the day. Options contracts only settle when they're closed or expire, right? Futures contracts settle every night at the close of the regular trading session. The cash flow can get a little confusing, so let's just take a moment to understand what's going on. All right, let's look at the end of day settle. Makes an options contract different from a futures contract. Let's say SPY's trading at 237.50. We think it will go higher. Buy, what did I say here? We buy one contract, costs us $4. The most we can lose ever is $400, right? Everybody agree? Okay. At the end of the day, SPY closes at 239. That call option should have a higher value. But unless we close the position, we don't have that cash. It's not ours. It's just on paper. If we hold the call option and SPY closes down 2 points the next day, say it's at 237, the call option has less value than when we bought it, but only on paper. No cash has moved from the account. In fact, right, the most money we can lose is this $400. But if we hold a futures contract overnight, say we get long the 2380 ES Mini futures contract. Now, at assignment, if the ES Minis go to zero, this is the max loss. Don't worry, ES Minis aren't going to zero, and we're going to be out long before assignment. But so we're long the 2380 contract. The ES closes at 2390. That's a 10-point gain. That's $500. And we'll get into how you figure out the actual value. At the end of the day, you get that $500. It's deposited right into your account. Awesome, right? But what happens the next day when the ES closes at 2370? Now remember, our entry was 2380. Closes at 2370. We're down 10 points, right? Oh, Lyral, all over it. Oh, very good. Oh, you guys are smart. That's right. Because of the settlement the night before, our position isn't long at 2380 anymore. We're actually long at 2390. And when the ES closes at 2370, settlement, we're down 20 points. And $1,000 is removed from the account. Now, you're only down $500 since the original entry at 2080 because you were given $500 yesterday. So when they take 1,000, they're just taking back the 500 they gave you, and then they're taking the 500 you lost. Is anybody confused? I know that's like a weird thing to try to explain. Did that make sense? It did? Oh my God. Okay. Amazing. Great. Awesome. All right. Well, if that didn't throw you, then you guys are going to do great with this next little goodie. Exactly, Derek. You only lose your own 500. You said that so much better than I did. Well done. Okay. So this next part, LIFO, FIFO, HICO, and LOCO. Type in a 2 if you're not sure what those terms mean. Yeah, I had a feeling about that. Okay. This is something that probably if you're trading stocks and options, you should explore a little more in depth, not only with your accountant, but also with your brokerage. LIFO, L-I-F-O, stands for last in, first out. FIFO, F-I-F-O, stands for first in, first out. HICO, highest cost out first, and LOCO, lowest cost out first. Now, these settings were originally created for tax treatment purposes to allow investors to control their tax costs by choosing if they sold long-term holdings or short-term holdings, right? Because if you're selling something you've held for more than a year, it's taxed at capital gains. And if it's something you've held less than a year, it's taxed as regular income. So FIFO and LIFO also affect your profit and loss in equities and options, especially if you're not aware of it before. This is something you should take a look at in your account. LIFO and LOCO settings on stock and option trades are what allows traders to choose to close the most recently purchased stock or option or the lowest cost shares of stock or option contracts to be the first shares or options sold. So if you buy more at a lower price, or just to confuse things a little, if you sell more at a higher price, price doesn't have to move all the way back to the first entry for you to be profitable. You can average down. So because you can choose which shares or options you're going to sell, what you're going to offset first. So you can improve your cost basis through the process of averaging. Like I said, if you don't know about this, you should probably look into it more deeply. I'm not going to get into all the tax implications of these settings. Just want to talk about how it affects your profit and loss, specifically LIFO, LOCO versus FIFO and futures contracts. Now, it's hard to explain in words, so let's just take a look at the math of it. I know, more math. Here we go. So let's start with last in, first out, and lowest cost out. When you're adding to reduce cost basis, LIFO and LOCO amount to the same thing. So from now on, understand that if I just say LIFO, it applies to LOCO on short-term trades. So LIFO and LOCO, right here, these guys. Here, I'll just make a star or some kind of squiggle. So let's say we decide we just want to stick a toe in the water and buy one long-dated SPY call at 4.5. Now, look, a toe in the water trade is never a full R of risk. If you're in a position that has a full R of risk, adding to reduce cost increases your risk beyond that 1R. You're probably breaking your trading plan. So, don't do this if you already have a full R on. But for the sake of this example, let's say we have some room in our risk, and it's a long dated call, say about 6 months out, and the initial trade's not a full R. So we buy one SPY 238 call at 4.5 right here, and SPY goes down. But we see an opportunity to add to the position to reduce the cost basis. So we buy 3 more of these contracts, and they cost us $250. And I'm going to change this pen color real quick, if I can, just so it's not the same color as what's on the screen. So $250. So our total of 4 contracts now is $1,200 or $300 for each contract. $300 per contract, 4 SPY calls at $3 each. So if we close all 4 at 50 cents above break even, that will be a profit of 50 cents per contract, right? According to LIFO, the last in, the 3 that we bought at $250 are sold at $350. That gives us 1 point times 3 contracts, 3 points of profit. The first one in that we bought at $450, we sell at $350. We lose 1 point times 1 contract, but we gain a net of 2 points. It's profitable. Okay. FIFO. Oh boy, help us. Have I lost anybody? Does this make sense? Silence, the final frontier. Okay. So moving on. And you can avoid all of this if you do, God forbid, average down with futures or average up. If you close all the contracts together at once at the same price and you're above break even, you'll be fine. I'll say that again. With futures contracts, if the price you close at is profitable for the average cost and you close all of them together right then at that price, there's no FIFO effect. Where things start getting weird is when we leg or scale out of a FIFO, first in, first out trade. And all futures contracts are first in, first out. There's no way to change it. It's an exchange rule. I hate it. You'll hate it too. But what happens if you're not aware of the first in, first out rule is you might think you're reducing your risk and being profitable, but that's not what's really happening to your account balance. Like I said, it all depends on how you exit. I'm not a fan of adding to reduce, but I know traders that do it, and we all get tempted from time to time. So I want to make sure everyone is aware that it works very differently with futures contracts, because the first ones in are always the first ones out. So again, this is way easier to explain with math than with language alone. So let's go look at another slide full of math. Let's start with something familiar. This options trade here on the left. If our account is set up under LIFO, we're over here now. Blah. Last in, first out rules. We can scale out of a trade easily. Everything works out great. We buy one SPY, 238 at 450. And we buy 3 more at 250. $1,200 total cost. LIFO rule. We close 2 at 50 cents above break even. So that's 2 at 350. Because, oh, there's a typo. This should be the 240. Sorry about that, guys. Yes, this applies to the ES minis. It absolutely does. So let me start over. We buy one 240 call for 450. We buy 3 more of the same call at 250. Brings our total cost to $1,200. Because of the LIFO rule, we can close the last 2 we bought, which are the cheap ones, at 250. We close those at 350. We make a profit of $1 each. Somehow I've got the wrong slides here. But that leaves us with 2. But because we've already gained, oh God, this is messed up stuff. Because we've made 750, it reduces our cost to 450 on 2 calls. In other words, we've reduced our cost from 450 and, oh my God, this is so convoluted. Look, we're left with two of the calls, and they cost us 2.25 each. There's just no good way for me to get through this. Okay, so LIFO, we can average down because we can choose which ones we sell first. Now, here's what happens first in, first out. We're not allowed to average. We buy one long ES at 23.82. Then we take a second entry to reduce our cost. I highly recommend against this, but we do it at 23.60. By the way, you should never be that far underwater ever in a trade. Okay, so if we average the cost, we end up with 4 long ES minis at an average cost of 23.65.5. Now, let's say we try to do the same thing over here we did over here. Let's sell half of our position 1 point above break even. And let's move to the next slide. Trading options, you should always sell EFO. You know what? Ask me that at the end and we'll come back to it. So what happens if we try to reduce risk the same way we did with that LIFO trade? Well, because of the first in, first out rules, the first contract we bought at 23.82, when we sell at 0.5 above break even, so we're selling at, let's see, our average was 23.65. So we're selling at 23.66. Oh, I wrote it down right here. We're selling at 23.66. So that first contract we bought is the first one that gets sold for a loss of 16 points. Then we sell the other one. And this is one that we bought later. We bought this one for 23.60. We closed it at 23.66. We're positive 6 points on that. But our net, we're down 10 points. And we're still holding 2 of the last 2. And they cost how much? What's our break even on those 2? We bought them at 23.60. Right? We bought one at 23.82. That one's gone. And then we bought 3 at 23.60. We sold one. Very good. 23.60. That's our break even on those. It doesn't matter. All of this stuff that we lost 10 points, these will still be profitable. And this is what it will show on our trading page, that they cost us 23.60. Not that we're in the whole 10 points. Now, for your account to break even, yes, you need to sell them for over 23.65. Yeah, okay, so basically, FIFO is, I don't know why they do it to us. It's just not, it's so not cool, but it's the rule. There's nothing you can do about it. So if you close them trying to get all tricky, reducing your risk, but still hold on for some more gains, you have to be careful and make sure that what you are not doing is locking in a loss. Like this one here, we locked in a 10-point loss, even though we thought we were getting out for above break even and we were taking off risk. All we did was lose money. I know that was a horrible, long, convoluted way to get there, but is anybody confused? Did that make sense? Now, yes, if you close them all together above break even, not a problem. It's when you start getting fancy and think, well, you know, I really don't want to have these many contracts on. And instead of selling all of them, you just sell some of them, thinking you're still going to be okay. Yes, it's an issue if you're trying to leg out. Exactly, Scott. It's only if you leg out. Like I said, if you're above break even on your average price and you close them all, not a problem. All right. So far, so good, sort of. Let's move forward. Don't worry if you're a little bit confused right now. We will go over the FIFO effect a lot more in the later classes. For now, the takeaway is adding to reduce cost works very differently in futures because you can only trade first in, first out. The easiest way to avoid it entirely, close them all, old and new, all at once at above break even or break even, and you'll be okay. All right. That was pretty heavy for day 2. Let's ease off the math. Let's talk about how futures margin is different from stocks and options margin. Okay. Deep breath. In the equities and equity options markets, that's a fancy way for saying stocks and options, a margin account allows traders to borrow money from the broker to trade. It's a pre-approved loan from the brokerage, and the assets of the account is your collateral. Margin trading allows a trader to trade a greater value of stock or options than you could using only cash. But because margin from your broker is a loan, the money that is borrowed accrues interest until it is completely repaid. Now, a lot of people talk about the margin when trading futures, but it isn't really margin, at least not margin like when we talk about stocks and options. Like so many futures market terms, the definition of futures margin is different from stock and options margin. Margin in the futures market is really a performance bond, like escrow. The cash is set aside in an account, and no one can access it until you close the contracts, which means that initial margin is just a performance bond. Now, by law, futures margins cannot be a loan from your broker. It must be cash. It must be your cash. It must be in your account. When a futures contract is bought or sold, that amount of cash called initial margin is removed from the account, and it's held separately until the contracts are closed. The initial margin, the purpose of it is to ensure the performance of both parties to the contract terms. It's a good faith deposit, not partial payment. And when you close the position, the margins return to the account immediately, plus or minus whatever money you made or lost on the trade. That's kind of it for initial margin. Any questions on that? Because we're about to go into another kind of margin. I want everybody to get this. Okay. Okay. I'm going to move on. Okay. Here we go. All right. In addition to the initial margin, which goes into this escrow of sorts, a futures account must maintain a preset amount of cash at all times. And guess what that maintenance cash is called? Don't be shy. This is like one of those Grant's Tomb questions. Guess what that maintenance cash is called? Nobody? It's called maintenance margin. Exactly. Maintenance margin, maintenance funds. And that money is used to debit any losses from day trades that close for a loss or things that are a little bit underwater, cash settlement at the end of the day. The maintenance funds are the insurance that the futures account can cover whatever losses take place. It's a cash cushion that stays in your account until the trade is closed or until nightly settlement. Now, since futures contracts obligate both buyers and sellers, both the buyer and the seller have to put up that initial margin, the cash on deposit, that performance bond that they take out of your account and set aside. And both the buyer and seller have to have sufficient cash in the account to cover the potential losses. That's the maintenance funds. Now, the amount of cash that's required depends on what you're trading and who you're trading with. It's usually between 3 to 12% of the contract's full value. And that's a pretty big range percentage-wise, but it's a relatively small amount of money compared to the value of one futures contract. So it puts your capital to work very efficiently. Again, this kind of leverage is super crazy awesome when a trade is going your way, and it is absolutely devastating if a trade is going against you. We'll get into risk, positive expectancy in a later class, but for now, risk is controlled through two things. We kind of talked about them earlier. Anybody remember those two things? How do we control risk? Stops, very good. And, oh, Fred Atwater, you've been studying. Yes, position size and stop loss. Very good. I saw, very good, you guys. Catherine, awesome. Naps. Okay, so position size, stop loss. That's how we control our risk. Now, there's another way options are different from futures. Like I said, you can buy and sell options with cash or on margin. Margin from the broker in an options account is a loan. Margin in a futures account is money that they take and set aside until you close the position, and it's a maintenance amount that remains in your account and gets debited or credited depending on how your trades go. Once the position's closed, all the cash comes back to you, plus or minus whatever you made or lost on the trade. If your account drops below a certain cash level, the broker's required to make a margin call. Now, that means that you must immediately deposit cash into the account to bring the account's cash up to the level of maintenance funds required. Or yes, when margin call is made, you deliver. If not, the brokerage will liquidate immediately at market enough or even all of the position to cover any of your losses. And you may actually end up still owing them money. Now, smart traders like us, we honor our stops so we control our risk, and losses are kept to a manageable size because we don't trade bigger than we can afford to lose, right? So no one in this class should ever be faced with a loss-based margin call. Now, we're not quite done with this whole margin situation because, like I was skipping ahead earlier, futures trades have two classifications. They are either a day trade or a position trade. Now, this is important. Listen up, because this affects how much maintenance fund and how much performance bond you have to have at the end of the night. Well, let's go. All futures trades are day trades. All of them start out as day trades until that bell rings. The close of regular trading hours for that instrument, they become position trades. Now, during the day, you see here where it says intraday margin? This is your initial margin. This is the amount of money they take on deposit if you're trading with, I don't know what company this is. Ninja Trader? It is. I think it's Ninja Trader. This is your intraday margin. You want to trade the E-mini, here's the ES. You want to trade the ES minis? $500 intraday margin per contract. That's cool, right? Now, keep in mind, it does matter what you're trading. If you're trading silver, it's $2,500. So, like I said, different for every instrument. And it'll be different from broker to broker. And like I said, this is intraday. That means closed before the session closes. Once a futures trade is held past the session close, it becomes a position trade. Now, I'm going to say that again. Once the bell rings on that instrument, an opens futures contract is no longer a day trade. It is a position trade. And this matters. It matters a lot because on day trades, like you see, the initial margin, this lovely little lighthearted column here, that's set by the broker. Position trades, anything held past the closing bell, are permanently subject until the position is closed to the margin requirements set by the exchange. That's these two columns here added together per contract. Initial margin and maintenance margin. These are the cash requirements set by the exchange. And yes, that's the sum of, let's see, this column and this column added together per contract. So during the daytime, when you're just using your broker, $500 for the ES Mini. Once you get to the nighttime and the closing bell rings, what is that? $9,660 per contract, cash in your account. If it's not there, guess what happens? Yes, per contract. If that money is not there, the broker is forced to close or demand maintenance funds deposited immediately. Yes, that is the dreaded margin call. That is a margin call not incurred by losses. It's incurred by the closing bell. You've got to make sure you know your instrument, know the hours it trades, know what your initial margin is versus the position version of initial margin, which will, by the way, reduce your cash cushion or maintenance margin that's still in the account. You see how it snowballs once that bell rings. The exchange's margin requirements, different for every instrument. This chart gives you just how big a difference. And we're talking about the exchange is always going to be higher than your broker. And if there isn't enough money, the broker is required to close enough of the position to bring the account into compliance, which, guess what, incurs a fee. So know your instrument. Trading hours matter. If a trade gets too far underwater, they might want more money. Again, if you don't have it, if you don't get it in there, maintenance funds drops below the minimum requirement. They're required. The brokerage is required by law to immediately liquidate at market. Losses can force the broker to liquidate an account, but the closing bell can too. You don't meet the exchange requirements. The broker's computer closes everything at 4:10 and you're liquid. You'll get your initial margin back, plus or minus any gains or losses that happened. And of course, a fee for not closing the stupid thing yourself. Holding a position past the close when there are insufficient funds to carry into the overnight session is really frowned upon. And if you fail to close your positions yourself enough times, the broker might revoke your day trading intraday margin privileges and require that your account meets the exchange minimums for all of your trades, including day trades. The whole headache, really easy to avoid. How do you do it? How do you avoid this whole headache? Anybody? Yes. Close before the session close. If it's a position trade, double check you've got enough cash in the account to cover the exchange requirements. And this is another great reason to control position size. Now, let me ask you this. Do you think that you and I are the only people trading that want to close our trades before the bell? No, we're not, are we? There's lots of traders closing their trades before the session close. So price action can get a little weird. In fact, sometimes it can be downright predictable. And there are ways to take advantage of that scurry to the exit before the closing bell, which we'll cover in a later class. For now, if you're a futures day trader, stay a day trader. I highly recommend avoiding that last minute crush to the exit, and that you close all your open trades by around 4:30 Eastern and just be done for the day. It's a lot more fun to watch the close when you're not desperately trying to close in the final crush before the bell. Which brings us back once more to the importance of, I'll answer all your questions later. Write them down and we'll get to them. The importance of know your instrument. I warned you, you're going to see this slide a lot. If you're trading futures contracts, those red letters there should be emblazoned across your brain. Know your instrument. The trading hours matter. Holding past the bell requires a larger account, and it should be part of your original plan for the trade. You've got to honor your stops. Every time a stop is moved, an angel loses its wings. No, seriously, moving a stop changes the risk from something you controlled and planned to something that's a potential blowout. Because if you move your stop once, well, when do you stop moving the stop? Maybe just one more point and it'll be okay. Or, well, maybe one more point and it'll be okay. It takes you out of the trade that you planned, and it creates chaos on the fly. Moving stops is a really bad habit, and it will nearly always eventually lead to ruin. Now look, maybe this sounds a little scary, and you're thinking, geez, you got to be crazy to trade futures. But once you fully understand how futures work, it's not going to be that scary. But it is serious business. Trading the futures market is like moving to the grown-ups table at Thanksgiving. It's the same meal, but you get a bigger plate, and the conversation is so much more rewarding, and the table manners are a little different. So now that I've scared you, all the crap, the living daylights out of all of you, let's move on to some of my favorite things about futures and how they're different from options. Option trades go through a middleman, the market maker. Anytime there's a middleman, they've got to make money, so there's a markup. Another thing about option chains, only show you the current bid and the ask. You can't see any of the orders that are just waiting in the wings. Stupid MM, I agree. With futures trades, you're trading directly through the exchange with the other traders. There's nobody in the middle. There's no market maker. What happens when you get rid of the middleman? Well, pricing is fair and transparent. Depending on your data feed, you'll be able to see at least the 10 closest offers to the current bid and the 10 closest asks to the current bid. Everybody can see them. And there's one more thing, the leverage. The ES Mini's leverage is like 20 to 1. I didn't bother to calculate it exactly. I could give you a fairly precise ratio. Options, yeah, they're highly leveraged, but I couldn't hope to calculate a ratio. By the time I figured it out, it would have changed. And why? Who could tell me why it's so hard to figure out what an option contract is actually worth and how much the leverage is? Delta, theta, gamma, rho, the Greeks, exactly. It's always in flux. By the time you figured out what the leverage is, it's changed. Futures contracts, no Greeks. And you know what? No implied volatility. You don't have the VIX messing with you either. Now, there's risk and there's opportunity in every market. We've gone through the major differences between options contracts and futures contracts, but there's one more really big difference, and I've included stocks also, just so you can compare. When you're buying stocks or options, you can never lose more than your original investment. Can you see this whole slide? I hope so. Okay, thank you, Jason. If a stock price moves lower from your purchase price, the broker doesn't require that you put more money in the account unless you bought on margin, and then, they'll probably just sell it out from under you. And it's the same with options. You can't lose more than you paid. With futures, it doesn't matter if you bought them or sold the contracts. It is possible to lose more than the original investment. And that scares a lot of people. It shouldn't, but it does. Look, in futures, risk is controlled by stops, no matter what side of this trade you've taken. I mean, it's kind of like how some people are afraid to short stock or sell naked puts. Well, why? Why are they afraid of that? It's because they don't know how to manage their risk in those trades. You've got to have a stop. Anything can happen at any time. So be smart, be protected. Always have an automatic stop loss in place as part of your order entry. Infinitely makes the risk associated with trading the futures market so much more manageable. You never know what's going to happen. The internet could go out, a bomb could drop somewhere, and the market reacts in a flash. You could lose your connection to the broker. The broker could lose their connection to the exchange. Have some kind of protection on your account. Don't just be playing it all by ear, even if it's just an emergency stop that, will only get touched if the end of the world is near. Have a stop. I don't mean to scare you. Well, maybe I do just a little bit, but risk management really is crucial. In the futures market, it's all about keeping your losses small, but it's also about never getting assigned 10 tons of live cattle. The financial rewards for the well-informed, disciplined trader of futures contracts can really be tremendous. Study hard, stay focused and disciplined. Always know the instrument you are trading. Keep your losses small. Never, ever, ever risk assignment, and you're going to be okay. What do you guys think? Are you feeling all right about this? You're picking names for your cows. I love it. LIFO, LOCO, and FIFO. Okay, thanks, you guys. All right. So our next class, next Tuesday, same bat time. You know the place, where to sign up. The next class is crucial to futures trading. If you're new to futures trading, this one is a must be there. It's all about ticks and points. You can't trade futures without knowing ticks, points, tick value, tick size. It's the class that's going to make it possible for us to talk about everything else, evaluating risks to reward, order entry, stop placements, profit targets, trade management, everything. So if you want to trade futures, class 3, ticks and points, it's a must. There's a lot of good futures brokers. We're going to get into that in class 4 next week. I'm not old at all. Oh my God, I could be your mother, Jeremy. Yes, you can paper trade futures. They call it the sim. I guess that stands for simulator. And yeah, in fact, I'm going to insist that everyone trades paper for a while. Someone was asking about the trading hours, and I just want to throw out there that the trading day begins at 6 p.m. the night before. Trading day does not start at the opening bell at 9:30 like you all think. So that's why you see gaps in the morning, is because while you guys are sleeping, the rest of us are trading the Asia market. We're trading Europe, and that's called Globex, and it flows all the way around the clock. 6 p.m. Eastern, yes, 5 p.m. Central. And then that day ends with the closing bell at 4:15 Eastern. And the market's closed from, it opens again for, 15 minutes, and lets everybody like squiggle around, try to get out of whatever issues they might have. And then it's closed, completely closed from 4:30 to 5 while they do the settlements. And then it opens again. Or is it? No, it's closed from 5 to 6. Anyway, we'll get into that. I don't have that stuff in front of me. And it has been a huge, crazy long day, as I'm sure you can guess. Is any other questions? I probably missed some because thought I was answering and wasn't. I am, Don. It has been an amazing week. Wow. Did I talk to you guys about crude and gasoline? Did you hear that part? I did not see the first notice date question. What was it, Fred? Oh, well, the crude, I was talking about how the market can do unexpected things, and I had some friends who thought about the hurricane and thought, wow, crude oil is going to skyrocket because of the hurricane. The whole supply chain is going to be interrupted. But the fact of the matter is, Texas isn't about crude production anymore. It's about distillation. So they got creamed. Instead of buying gasoline, they bought crude. Crude went down, gasoline went up. It's a little tricky. You've really got to know your instrument if you're going to do those kinds of newsy trades. Yeah, one missile from North Korea can change everything. And I'll tell you, when I heard that, I got online and I bought with both hands. And I just closed it today. Awesome trade. Made my month. I mean, way to go, August. I think a few of you might have been with me for published first notice dates. Is there a recommended exit time prior to that date? Yeah, and we'll cover this in more detail when we get into trading different instruments. But yes, I like to get out at least 3 days before first notice day. The reason for that is every once in a while, there's just some snafu where, I don't know, the order didn't get through, or you didn't get a complete fill, you only got a partial. So I like 2 to 3 days before, because that gives you a little wiggle room in case something goes wrong. You still have the opportunity to fix it before you end up having to deal with cows or pigs or bushels of God knows what. It's always nice to have a little time cushion. What did I buy with North Korea? I got long the ES and NQ, and I shorted gold, bonds, and the Japanese yen. I was feeling pretty confident. Shorting against the box rule. What does that mean? I don't think I've heard that phrase, Fred. I mean, they have limits. You're only allowed to Oh no, you can't do that in futures, but I do know some workarounds. If you're in a contract long and you want to short it also, you can go out to the next contract expiration. You can trade two different expirations, or you can also take the opposite position in a correlated instrument. One thing I really like to do if the ES is tanking is to buy bonds, because you can use the bonds to hedge a long ES position. It's complicated, but because the bonds trade, now I'm talking about the 30-year, because those trade, each tick is, what is it, 31.50, 31 quarter per contract, but the ES is 12.50. You can hedge one ES contract with just, you can hedge two ES contracts with one treasury bond position. Or you can use different contract expirations. No, Pat, this is the worst of it. It only gets better from here. And let me tell you, the only thing scary is not knowing what's going on. Once you understand everything, it's rocking. Futures do gap because they are closed for 15 minutes after the bell, and then they're closed for, I'm sorry, my brain is so fried, and and then they're closed again for the settlement period. And we'll get into all of that. Sometimes they do gap, and actually sometimes when things are sudden and terrible, they can gap really hard. And we'll get into down limits and up limits. There's a limit how much the market's allowed to move, and then they don't let it trade. They stop the trading and restart. Oh, it's getting quiet. Yes, election night. We were limit down election night. Yeah, gap on Sunday open is very common. Pairing well, Fred, there's one thing about hedging is really like hedging a position in the futures is for when something's not quite working the way you thought, and you don't have the balls to just close it and take the loss. People use hedging to like fix. Now, if you're hedging all the time, what happens is you end up with a net zero gain, because one side loses and the other side wins, and you end up with a zero net. So you're just risking money to make nothing. We'll get there, Fred, I promise you. Yeah, it's insane the amount of money you can make in a day. And once you start building up your account and trading size, really it's just the way to make money is not to trade over and over and over. The way to make money is to have one good setup that has a high probability. You put it on with some decent size and you let it run. You never move your stop because you agreed to risk that much from the first place, and you just let it ride all day or until direction makes a clear change, and life is beautiful. It's a very relaxed way to trade. It's awesome. Jamie, you want insanity? Yeah, that's good advice, Brandon. Trade penny stocks. John, you traded futures for the first time today? Wow. Okay. Here's my advice to you. Stop. Yes, you got lucky. The market has a way of, when you're new, just making you feel unbeatable. And in the end, it will take everything it gave you plus another 200%. Now, unless you've had a lot of education and you know what you're doing, I would say take that 12 grand, take it out of your trading account, put it somewhere else and save it. I will not be walking anyone through opening a futures account. This is, all you have to do is, I will give you a list of brokers, and I will recommend some charting software, trading software, but opening a futures account is just paperwork. It's just like opening a regular trading account, only it's futures. Your stop was a quarter on futures? Okay, yeah, John, stop whatever you're doing. You got away with it today because we had a clear trend. Be very careful. Tomorrow we may get a little bit more of the same, but September is a pretty rocky month, and I really don't want you to lose all your capital before you get to learn how to trade in a really good way. I think it's great that you're able to, okay, awesome, dude, deal. Yeah, I spend more time learning than I do trading too. Even after all these years, I'm still constantly searching out for new and unusual ways to figure out where other people see support and resistance so I can take advantage of it. All right, you guys, I trade by myself. I have people that I Skype with in and out during the day when things get slow or I'm bored. Yes, you can trade futures in an IRA. Thank you to, was it you, John, that figured that out? My guess is a lot of brokers will allow that. If TD Ameritrade does, they all do. Well, thank you very much for looking into that for us. What's coming? What do you want about, Jeremy? Oh, Derek. Well, you have to decide regarding LIFO or FIFO, what's best for you. It sort of depends on what kind of account you're trading and what your tax situation is. If you've got positions that you've had forever, like some people have stock that's been left to them by, family members, and it's a stock that somebody in the family bought for $9 and it's trading at $3.50 now. They can't sell it because the taxes would be huge, but they still want to trade that same stock. Like say somebody bought Apple stock way back when and they got it for $20 a share and they left it to you. But obviously now Apple stock's split at least once, and it's worth way more than $20 a share. You don't want to sell those shares. But if you still want to trade Apple stock, you can use the last in, first out rule to day trade Apple without letting go of your historic shares. Hopefully that helps. Oh, Avery, I'm sorry to hear that. That's a bummer. You're welcome, Earl. George, good night. Thank you for coming. Even though my brain is like on stumble mode. You're welcome, Sammy. And you, Jamie. Thank you, Brock. Is it possible to hedge, say, 350K in SPY? Yes, absolutely. And that is a huge topic, Fred. Hedging is a monster, and maybe you and I can talk about it separately. It may be that SPY isn't even the appropriate instrument for you to be using. It depends what the stocks you're holding are. For example, and we'll get into that, the makeup of the different indexes and beta. We're not going to get into beta rate weighting your portfolio. I mean, that's a huge topic, and Maybe Jeremy will slip you my email, and if you have a specific question, I can help you with it over the weekend. Oh, you're welcome, everybody. Oh, great. Thank you for coming back. Some people do buy e-minis to hedge stuff. I do it to trade and make money. I pay my bills. Everything. All my money comes from trading. So, all right, you guys, I'm going to call it. It's been a long one, and I think tomorrow and tonight are going to be exciting too. And you're welcome. I'll see you all next week. Take some points.